Hey guys, it's Nick, and in this video, I want to talk about the SEC news that they busted these two traders that were using wash sales in options to get the rebate fees that the exchanges charge for their maker-taker fees. So I'm going to show in detail how the scheme worked, what a wash sale is, why it's illegal, and what maker-taker fees are, and who are the brokerages that were involved. It is most likely Robinhood and Interactive Brokers were the main ones, and they switched to some different brokers later on. So we're going to take a look at how this was all done. And some of you may be happy to know that it is probably some market makers like Citadel that pay for order flow from Robinhood that lost a lot of money in this scheme, and that's probably why this was prosecuted in the first place, because let's face it, these guys are really little fish. And so the SEC went after them to show that they're doing something, while the really big fish are getting away with all kinds of things that are a lot worse and a lot more money involved. So here is the article saying that SEC charges individuals in meme stock options trading, as if the meme stocks had something to do with it. It really didn't. So they say that they charged two individuals with fraudulent trading scheme involving so-called meme stocks and aimed at taking advantage of a surge in retail trading driven by social media in early 2021. So these guys profited off so-called maker-taker pricing offered by exchanges, in which resting orders that provide liquidity by executing against other orders receive a rebate payment by trading options contracts with himself using various brokers. Okay, what the hell does that mean? I'll get into that in a minute. So they say the main guy, Gu, executed 11,400 trades, netting $668,000 in rebates, while his friend did 2,300 trades and got about $50,000 in rebates. So how did they do this? How did this work? How does the rebates work? And why is wash sales illegal? Let's talk about that. So the whole gist of this scheme is basically to use two brokers, say Robinhood and Interactive Brokers, whereas Interactive Brokers pays you for adding liquidity, meaning you are a maker, and Robinhood doesn't charge you for taking liquidity, being a taker. And so the arbitrage between those two is how they made their money. And they did this by placing an order with one broker and taking the opposite side of that order with the other broker. Essentially a wash sale, meaning they post it for one price and they trade at that same price. So no money is made or lost. It's just a flat to them, but they get the rebates from that. And so they keep doing that in larger and larger amounts to get that rebate. Now, there's nothing wrong with trading to get rebates, but it is illegal to do wash sales. And the reason for that is, now it is not illegal to trade just for the sole purpose of getting the rebates, but it is illegal to do it with a wash sale. Because wash sales are illegal because even as far back as 100 years ago, people would use wash sales to kind of show interest and put artificial volume on a stock to get interest that, hey, this stock has a lot of volume, and people would start buying it because of that. And so that's why it's illegal. And this is not what these guys were doing in this case, although the SEC claims that some of their wash sales did draw some interest from other traders, and they piled into some of these options that normally they might not have. And even though these guys did wash sales on a really grand scale in really illiquid options, there is wash sales going on with high frequency traders, probably not that concentrated, but it does happen to get rebates. So it is going on right now as well. So what are maker-taker fees, and how much are these fees, and how did they make this money using this kind of scheme? So in the SEC complaint, they say Exchange A charged a take fee of 50 cents per contract at the highest volume tier, and paid a make rebate of 53 cents per contract. Exchange A paid the 3 cents difference itself to incentivize liquidity on the exchange. When a trade from broker-dealer A was executed on Exchange A and earned a rebate, broker-dealer A passed 43 cents per contract back to Gu or Lee and kept 10 cents for itself. In the SEC complaint, they talked about the example of Rocket stock on March 4th, 2021. It had a price of $26.86. And this guy Gu traded the $5 strike price on the put options that expired June 18th, 2021. So about 3 months out. So this is not the actual price, but let's just say that this is where the $5 put option was trading, 50 cents bid and 90 cents ask. So the way the maker-taker rebates and fees work with somebody like Interactive Brokers is if you are adding liquidity to the bid or the ask, then you receive the rebate. If you are taking liquidity from the bid or the ask, then you are charged the fee. That is at Interactive Brokers, but Robinhood doesn't charge the fee or give the rebate. So for example, if you put a market order to sell your puts on the bid, that is taking liquidity away because you're taking this 2 contracts from the bid away. Or if you put a market order to take the ask here, you are also taking liquidity. Conversely, if you have limit orders at the bid, you're selling at 50 cents on a limit order, that's still taking liquidity. And if you have a limit order to buy at the ask of 90 cents, you're still taking liquidity. So you're going to get charged the fee. However, on Interactive Brokers, let's say the bid is 50 cents and you put an order here at 40 cents to buy 1 contract or whatever. You are now adding liquidity. You're adding contracts to the overall market. And so you get that rebate. Same as on the ask. So let's say you went and offered at $1.10 over here. It's a not marketable order at the time. Even at 90 cents, you are adding liquidity. So you get the rebate. Now with Robinhood, no matter what you do, you can place a bid here, you can place an offer here. It doesn't matter. They're not going to pay you a rebate, but they're also not going to charge you a fee. And this is where these guys made their money. So they would use Interactive Brokers to get the rebate, and then they would use Robinhood to go even out or wash that trade and not have to pay any fee. And so the difference, they got to pocket themselves, and they did it many times on a whole lot of options contracts. So here's the example on March 4th in the SEC complaint on Rocket Companies, ticker RKT, the $5 strike price, expiration June 18, and Rocket was trading at $26.86 that day. So basically this $5 put is way out of the money. And if you were to buy this thing, it's basically saying that you're betting that in 3 months, the price of RKT stock will be below $5 a share. And so if it does trade below $5 a share, then you will make money after accounting for the premium you paid to buy this $5 put in the first place. And so it's unlikely that the stock will trade under $5 by June 18, but even that they didn't really care about. They just cared that when they placed a sell order for the option that day, they didn't want somebody else to come and buy it, because then they couldn't do their wash trade. They would actually be liable for being short the put. So here they say, Gu places non-marketable limit order to sell 500 put options contracts, broker-dealer A, that's most likely Interactive Brokers. And then they place a marketable order to buy 500 put options contracts with broker-dealer B, most likely Robinhood. And so Gu's order to buy 500 contracts executes on exchange A. Gu pays no take fee for this side of the trade, right? This is the Robinhood part that he's actually buying something. And here is the Interactive Brokers part that he is selling the put. And so Gu's order to sell 500 contracts executes on exchange A, and Gu receives $215 in make rebates for this side of the trade. So let's say this was the market for that $5 put option, 50 cents bid and 90 cents ask. He places an order to sell 500 contracts here better than 90 cents. So maybe 89 cents he puts it here, right? And nobody is buying this contract at any time at 90 cents, but maybe somebody's going to buy at 89. You never know. That is a slight risk that he's taking. But there's almost no volume in these contracts. Nobody's trading them. There's no open interest or very little. So there's very little risk that when he places this order here, somebody else comes and scoops it up. But as soon as he places the order, then he opens up his Robinhood account and comes and buys these put contracts, the 500 contracts. And so on the one hand, he gets a rebate from Interactive Brokers for making liquidity. And on the other hand, he would normally get charged a fee for taking liquidity. But since Robinhood doesn't charge that fee, he doesn't pay that fee. So he nets that maker rebate through Interactive Brokers. And on the other hand, he doesn't pay the taker fee through Robinhood. So it's kind of like a little arbitrage going on here, and that he just does a whole bunch of times. And so like it says, broker dealer A passed 43 cents per contract back to Gu or Lee and kept 10 cents for itself. Now, if you look at the options trading commissions for Interactive Brokers at different levels, if you trade more than 100,000 options contracts in a month, you're only paying 15 cents per contract commission plus $1. So take 43 cents, subtract 15 cents, along with some other fees, 3 cents, regulatory fee, FINRA fee, and this and that. And that's how you see how he made the money. So let's take a look at how much he was actually making. So Gu had 11,400 wash trades. And in those trades, he traded 2.9 million options contracts. Now, that doesn't mean shares. That means one option contract represents 100 shares. So he basically traded 290 million shares worth of options contracts. And he made $1.37 million in rebates before fees and commissions, which comes out to about 47 cents per contract. And he made about $668,000 after commissions and fees, which comes out to about 23 cents per contract net. And his partner Lee didn't do as much as he did, 2,360 wash trades, 405,000 option contracts traded, 174,000 in rebates, or 43 cents per contract, and netted around 51,000 after commissions and fees, or about 13 cents per contract. So before I show you how this all works, I'm going to show you how a market maker that pays for order flow to somebody like Robinhood could lose a lot of money doing this, in this case, to these guys that are doing these wash sales. So looking at Robinhood's payment for order flow disclosure in the second quarter of 2021, here is how much they get paid for options by the different market makers. And Citadel pays the most, and they pay 54.09 cents per order for marketable limit orders. And this is what these guys would have been placing when they entered their orders to buy back the option from the order that they placed with Interactive Brokers. So I'm not saying Citadel was the one who was losing here. It could have been Wolverine, it could have been Global, it could have been Morgan Stanley, it could have been a combination of all of them. But I'm pretty sure they saw that they were losing money on these weird options trades that didn't net them anything, and that definitely made a red flag. So let's see how this all worked. So here's how it works. Let's say this is the guy Gu. It's not, it's just a stock photo, but he places the order to sell 500 put options on the offer to Interactive Brokers. Interactive Brokers doesn't sell his order flow to any market maker like Citadel. They place it right on the exchange. I'm not saying it was CBOE, I don't even know, but the exchange sees that he adds liquidity, so he is a maker. So because of that, they return 53 cents to Interactive Brokers, who keeps 10 cents of it and then returns the remaining 43 cents to Gu. Okay, so he is making 43 cents per options contract. So on the 500 contracts, that's $215. Now, so then Gu places an order to buy 500 contracts at the same price that he offered it out over here. So that is the wash sale. He doesn't make money, he doesn't lose money, but he gets this rebate. And let's see what happens on this side with Robinhood and Citadel or whoever the market maker is. Robinhood gives that order to Citadel in the hopes that Citadel could make money on that big spread on this options contract. So this is where they make money on these big spreads. If they get a buy order and a sell order, they get the spread. And so they make a lot of money on that, but they don't always make money on these contracts. And so if it is not something that they can internalize and trade within themselves, they send it on to the exchange and display it or execute it if it's a marketable order. So what happens is Robinhood gives them the order, Citadel pays them 54 cents per contract for that order, or $220. So Robinhood gets $220. And since Citadel cannot internalize this order, they send it off to the exchange, who then charges them 50 cents per contract for taking liquidity out of the market. So Citadel is out $1.04 per contract. If it is Citadel or whoever, in this case, I'm using Citadel, they're out $1.04 per contract on 500 contracts. That's $520. Now, this guy keeps doing that, and Citadel keeps going, why are we keep losing all this money on these obscure contracts that are way out of the money, that never trade? All of a sudden, they're trading thousands and thousands of contracts every day, and we're losing tens or hundreds of thousands of dollars. What the hell is going on here? And this is how I guess all these red flags started, because Interactive Brokers saw it, Robinhood saw it, and probably the market makers that were losing money saw it. And so they raised a red flag, and that's how I guess the SEC got involved in all of this. And just to show you how much of the market they were actually trading, this is the March 4th trading data for these four stocks, and the puts that these two guys traded were 229 contracts, but the total puts traded for the day in just AMC was 362,000. So their percentage of just the puts for these stocks during that day was 63%, 89%, 80%, 60%. So their trades stuck out like a sore thumb. And so that's what garnered all this attention, that all of a sudden these way out of the money contracts had all this volume. And the minute they posted an offer to sell, another buyer came in and bought these contracts. So something was really fishy, and it wasn't probably too hard to figure out what was going on. Now, he probably would have gotten away with it if he would have stopped after they first closed his accounts, but he continued and tried to hide it using friends and VPNs and all kinds of stuff. And here's a funny part here. It says, during investigative testimony, Gu said that although he is not currently using his trading strategy, he may do so in the future. Gu also admitted that he continued to engage in wash trading after receiving the SEC's investigative subpoena seeking sworn testimony and documents. So if he would have stopped there and not said he's going to continue doing it, they probably would have just looked the other way and, got him to stop, and that might have been the end of it. So did the SEC catch two really big criminals and stop this big market manipulation? Or are these just two little fish that they busted because they could and put out these press releases to show that they're actually doing something while the really big manipulators go unpunished? In my opinion, these guys didn't really do wash sales because they weren't trying to manipulate the volume or the activity in the stock. They were just trying to get the rebate. So it is a tiny, tiny, tiny deal, although they did make a lot of money off the backs of some market makers. So that's probably why they got brought up on charges, and they agreed to, I guess, give up their gains and not do it again or something like that. My favorite part of this article is the SEC patting itself on the back. So here they say, this case demonstrates the SEC ability to quickly investigate and expose complex trading schemes, including those conducted during times of significant market volatility. Joseph Sansone, chief of the SEC's Market Abuse Division, said in a statement. Yeah, they are on the case. I guess the SEC catching these two little guys making a few dollars in rebates is way more important than actually doing something about Dallas Fed Bank CEO and President Robert Kaplan and Rosengren, who is the Boston Fed Bank CEO, I believe, who were doing all kinds of millions of dollars, hundreds and tens of hundreds of millions of dollars in stock trades, while at the same time they knew what the Fed was going to do in terms of bailing out the stock market in 2020 when the whole pandemic started. So here these guys now announce that they are going to resign and retire and walk away with all of their earnings that they made. And hint, hint, it's way more than these two guys made with their little rebate scheme of $600,000. These guys made millions of dollars, apparently, based on what they showed of their trading in their disclosure. Maybe the SEC is not going after these two big guys because they did so much work catching these two little guys, and now they need some rest and relaxation. And if you want to know what the SEC employees do to take a break during a hard day of work, take a look at these old articles from 2010. What else? What else? So yes, it seems the SEC is busy most of the day, and that's why they can't go after everybody. So they catch the little fish and let off the big fish. So guys, that's a look at what this whole wash sale rebate scheme is all about. And this is what the SEC is going after. Please leave in the comments. Let me know if you think that our tax dollars are well spent having the SEC go after these two little guys, or should our tax dollars be used to go after these big guys like so-called Fed presidents and things like that? Hope you like this video, and I'll see you in the next one. Thanks for watching, guys.